Hello Sector Watchers, welcome to the show. This is the 187th episode of Sector Spotlight for Tuesday, the 8th of August. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. I told you I'm going to try to do it on Monday. This week it didn't work out because of some schedule clashes, but it is Tuesday morning, the 8th of August, long before the US markets are going to open. So I want to take this opportunity after seasonality and after long-term charts to take a look at the current state of rotation in the asset classes and sectors. So no time to waste, ladies and gentlemen, this is Sector Spotlight. I'd like to start with a look at the rotation of the various asset classes. It's been a while that we talked about them, so it seems a good opportunity to do some sort of a reset, some review, see what's going on. The RRG, the weekly RRG is shown on the left, and we're going to concentrate on that weekly rotation just to set the framework for, what's ahead of us in the next couple of weeks probably. And as you can see, that's this image is still quite, call it distorted by the outlier, which is Bitcoin. The good news is that this outlier has started to curl back up while it's inside the weakening quadrant, and we know that that is usually a good thing. Mind you, this is all based on relative strength. So Bitcoin is picking up based on relative performance versus VBINX and versus the other asset classes on the plot. It doesn't necessarily mean that Bitcoin will, by definition, go up in price, but we'll take a look at that in a minute. For now, I'm going to Well, no, I'm not going to do that. The other two outliers are commodities. These are DJP and GSG. You can see how these tails are actually very strongly moving inside the improving quadrant, heading towards leading, which is a pretty good thing because you may remember, you may know that commodities have been in the doghouse for quite a while, and it looks as if they are getting back to life again, which is interesting, and we need to look at the chart for that. Before I'm going to take them off, I'm going to bring up the individual charts for these three tails, and then we're going to talk about the other ones when we blow up the RRG. So first, Bitcoin. If you look at Bitcoin, and you can see that barrier, we talked about it many times, 30,000, 31,000, 31.5, all that entire area is a very heavy resistance area for Bitcoin. And you can see it here on the weekly chart. It's, the last attempt a couple of weeks ago failed. I'm not going to say failed miserably because it really didn't. It just tried and tried and tried, didn't work. There's a lot of selling going on in that area, and that's been pushing the price of Bitcoin in US dollars down. But we're still comfortably above the previous resistance area, which now should start to act as support. So what I'm watching here is whether Bitcoin is able to put in a new higher low, and that'll happen when the new low, if it comes, will be set above roughly 25k. After that, the break above this resistance area remains crucial for a further appreciation of Bitcoin versus US dollar. It didn't work this time. It looks as if the market needs a little bit more of a refueling, of a breather. But this chart in itself did not all of a sudden turn bad or pointing to very weak prices of Bitcoin going forward. That will only happen when we drop below 25,000, but I don't think that's in the cards right now. I'm actually looking for a new higher low to be put into place, and then a new attempt to take out that overhead resistance area in that 30k area that has been so important for many times. The second and third tails that we need to discuss are DJP and GSG, the commodity markets. And I'm going to put that in a longer term perspective. Let's start with the weekly charts for DJP. You can see that for a year, more than a year now, DJP is in a very clear downtrend. It worked out a channel since Q3 2022. And we now left that channel. We're pushing against the last high, which is around 33 US dollars, 32.70, 33 US dollars. is the previous high. That's now acting as resistance, but we've clearly left that falling channel, and we have started very carefully a new series of higher highs and higher lows. If you look at the relative strength versus VBINX, you can see that the last low didn't really dip much deeper. So it looks as if we're consolidating here, and I can see that thing starting to move higher, and the RRG lines are sort of anticipating that move. You can see how the RS momentum line has already crossed above 100, indicating that there is a positive momentum shift undergoing, and that's starting to drag the RS ratio level higher, and eventually that'll put it into the leading quadrant when both lines go above 100. But it's definitely a good start, and it looks as if things have changed for about a year and a half. Quite similar picture in GSG. Also, you know, that downtrend has been turned around. Here, this is even a little bit stronger because we already took out the previous two highs, and we're now pushing against a high that was set in January 2023. That's around $22 US. If that's been taken out, that'll be a very good confirmation of that low being put into place. And you can see here how this relative strength line versus VBINX has now turned around, and it's also, just like DJP, dragging the RRG lines higher. For commodities, I am going back to DJP. I'm going to put that into a monthly time frame because I think that shows better what I'm looking at. I've been talking about that big bottom in commodities going forward, and we had that massive move here that started back in 2020, lasted for almost 2 years, and then we went into that decline. That decline turned out to be at least a lot bigger than what I thought. I thought this was the turnaround and we would just continue to go higher, but look how this high here back in 2014 acted as resistance. We got into this downtrend. However, on the bigger scheme of things, this looks to be becoming, it's still a bit early on the monthly time scale, but this definitely could become a very nice new low being put into place. And when you look back, you can see that it is pretty much in the area where we had the high in 2021 before we had that real breakout, and the consolidation back in 2015, and then the low here in 2009. So I think that the level at which this low seems to be coming in is pretty crucial, and it could serve as a very strong jumping board for commodities to push higher, and I'd say at the minimum go back to 40, 50. That's the overhead resistance here in DJP. And if we do the same exercise and move from the weekly to the monthly chart for GSG, you can see a similar image, and you can see how that low touched. Look at that. This is 1860. Let's see what this is. The low here, 1930, 1928, 1919, and here we are with a low at 1870. So that's only a couple of dimes off of that low that was set in 2001, mind you. That's a long time ago. And we can see how it became a little bit more close here, 1830, 1881, and here again the 1870 low. So it's definitely respecting the level of those former highs and lows. Again, very good jumping board for a move higher. Initial target for GSG, most likely around $26 US. So that's about $5 from the current level. That's about 25%, a little less than 25%. For now, I'm going to switch off Bitcoin and the commodity tails on the RRG so we can zoom in on what's going on with the other asset classes, so GSG and DJP, and then we're going to fit that right back in there. And here we see the, I think the story of recent movements. You can see how SPY stocks are still inside the leading quadrant, but they are rolling over, they're losing relative momentum. And on the opposite side, as usual, you see the fixed income stuff picking up. So we've got government bonds, we've got corporate bonds, and we've got high yield inside lagging. but picking up relative momentum. Does that mean that all of a sudden now the preference for stocks is over and we should all move to bonds? I don't think so, because SPY is still way on the right-hand side and government bonds are still way on the left-hand side. But there is definitely a temporary setback, a temporary move going on right now. This could turn out to be a bigger switch, but right now I can't see that, and I just want to focus on what's actually in front of my eyes and what's actually happening in the markets. And what I can see here is that stocks are still way better than bonds, but they're going through a bit of a corrective move. Again, this is all based on relative strength, so it is very well possible that both markets, so stocks and bonds, are going down, but stocks go down less fast than bonds. So we do need to look at the price chart of SPY and bonds to actually wrap our heads around whether we are going into a price correction, which is relatively better than for stocks than for bonds. We'll look at the charts in a minute. And the big outlier here is the US dollar, which has rotated back into the lagging quadrant from improving, and that's pointing to US dollar weakness, and it's actually a pretty strong signal, I've got to say. We went through improving and rolled over and now started. Look how long the tail here is. So here it's a relatively short tail, and now when I scroll forward, you can see how that tail all of a sudden expands and becomes bigger, and that indicates that there is quite a bit of power behind that move in terms of dollar weakness. Let's take a look at the charts. Let's look at the price charts for SPY and GOV and the US dollar. So here is the chart of SPY with the relative strength versus VBINX. And what you can see is that on a relative basis, SPY actually recently took out the previous high, and suggesting that there will be more relative strength for SPY, for stocks going forward. And that's totally confirmed by the RRG lines, which are both above 100, but you can see how the green RS momentum line has rolled over and is now moving lower, but the RS ratio line is still at a relatively high level, and it's starting to get dragged down, but that's not a super negative yet. So from a relative perspective, I'm still going to stick with a preference for stocks inside this group of asset classes. When we look at the individual charts, you can see how SPY has kind of spot on run into that resistance area, that previous peak that was set in March of this year. That was 462.07, and here we are at 459.44. That's about a point difference in all these months' time. So that's definitely an area of resistance. I've sort of penciled in another one here, which is 458. That was a couple of weeks earlier, and it runs kind of because the highs here, the closing prices were considerably lower than the extremes. So I just put in that sort of penciled line, and it gives you a bit of a resistance range, a resistance area. Let's say around 460. I think that fairly accurately describes the situation at that level. If you just look at the recent price action, it's just higher highs and higher lows. So that rhythm, that uptrend has not changed yet. Just look at the price action. As a matter of fact, the low of last week was 446.3, and that's pretty close to 443.9 and 444.3. That was, in June, 2 weeks in June with a high. So with that, in that respect, the series of higher highs and higher lows is still there. What could possibly throw things over? I'm looking at the RSI here. This is kind of a negative divergence, not super strongly, because the highs in the RSI are at the same level, but the highs in the price chart are significantly higher. So it's still, the RSI is not confirming what's going on in the price chart. And by definition, that means that there is a divergence, and a negative divergence in the RSI suggests at least a pause, potentially a turnaround of price. With the current price structure there and this mild divergence, if you want, I'm gonna assess this as a temporary loss of momentum, a temporary setback. Where could it go? For the time being, I'm continuing to watch that 444 area as an important short-term support level, but we could even go back down to 430, and then we're back into this kind of bigger scheme of things, and then this is just one move. If you look at this low, high, higher low, higher high, higher low, higher high, and then, you know, wherever we're going to put that new higher low to keep that longer term uptrend in place. If you look at the government bonds, then that's the reverse picture, of course. What you see here is that we're hovering above a support level that was set earlier this year, around 2250. More importantly, the relative strength of government bonds has dipped to its lowest level in many, many years. And that suggests a further decrease in bond prices, and that's pushing yields higher. And that's the only, I think, disconnect that you may see, where we could see bond yields, so bond prices and the resulting yields being causing pressure for stocks. Again, as I said, it's all based on relative, so even if that happens and both markets go down, it still looks as if stocks are the preferred asset classes and bonds will drop faster. But if that happens, that is not a really good thing, and I'm looking for this level here and the low earlier the year, which is around 2220. So the longer term picture for stocks, I think, still there. What could throw it off? What could throw a spanner in the wheels is when bond prices really start to come off and come down and push yields higher. Stock markets usually don't really like that very much. And then finally go to look at the US dollar. So here's the US dollar index, and you can see how that has come down and has started. This is a super serious move here, and then you got, you know, lower highs, lower lows being put into place, and it looks as if this rally here is now working in putting a new lower high into place, and that is all, and as you can see here, is causing that tail of the US dollar index to roll over and move back into the lagging quadrant. So I'm afraid not a lot of good news for the US dollar at the moment, and you can transfer that to euro dollar, and that's obviously the reverse. So a rising euro dollar means US dollar weakness and euro strength, and you can see how that series of higher highs and higher lows here is still in place, and it looks as if we're just in a new down lag in euro dollar as we've seen it earlier in the year. The only thing that could turn this whole thing around is if we drop back below 106, 104, but that's way off right now. So for the time being, we just have to stick with the scenario that euro dollar is in an uptrend, US dollar weakness, and we're just in a small setback period looking for a new higher low to be put into place in the euro dollar exchange rate. So let's now move over to the sectors, and we have the RRG showing the rotation for the US sectors on the left hand side, all on the weekly scale, just like the asset classes that we just did. And let me point out that there's quite a distinct opposite rotation going on. So we've got only three sectors on the right hand side. So there's discretionary, communication services, and technology. And all three are moving lower on the RS momentum scale. On the opposite side, we have all the others, and they're all moving up on the RS momentum scale. The thing is that discretionary and technology together, communication services not so much, but these are the bigger sectors. So there need to be a lot of sectors on the left-hand side to offset the weight for discretionary and technology on the right-hand side to even everything out. What I see, the way I look at this is that this is pointing out a sort of a momentum change, because you can see how they're all still on the left and all on the right, and they're moving in opposite directions on the RS momentum scale. Not so much on the RS ratio scale yet. So the relative strength is still in favor of the sectors on the right-hand side. They're still in relative uptrends, but they're losing a bit of power. They're losing a little bit of relative momentum. The opposite goes for the sectors on the left-hand side. These are all still in relative downtrends, but they're picking up relative momentum. Now, obviously, when things really start to move to the right, and industrials, and to a lesser degree, materials seem to be starting to do that, financials. But like, so here, the red ones, that's staples and healthcare, they're still just pointing straight up. Real estate, almost straight up. Energy, nice move, slightly moving to the right. So when they start to pick up relative strength as well, that means that they move higher on the RS ratio scale. Then things really start to turn. Obviously, there's still the opportunity that the rotation takes place completely on the left-hand side or completely on the right-hand side for, in this case, communication services and technology. So the closer they are to crossing over the 100 axis in the RRG, the more reliable it is. And for me right now, I think that the sector that is closest to doing that is industrials, XLI. Maybe followed by XLB, the materials sector. Other than that, this rotation still indicates like growth sectors, technology, discretionary, industrials, materials being the leading factor. If I break them down into these three groups, we can see that a little bit more pronounced. So here are the offensive sectors. So you can see how discretionary has been leading that dance. But you can see how materials, financials, and real estate are picking up. These are also cyclical offensive sectors. If we move to the other side, to the defensive sectors, then we see that these are all still in the lagging quadrant, but they're primarily picking up relative momentum, not so much RS ratio, not so much relative strength. So people are still, this for me, this is sort of a temporary move for the time being. At least that's how I assess this move as being temporary, because there's primarily only relative momentum while they are still in a relative downtrend. So it's a little hiccup within a downtrend. That's the way I look at it for the time being. And then finally, if we have the sensitive sectors, they're continuing to play out the rotation that we've seen a while ongoing already. Energy seems to be picking up really nicely right now, although it is still very low on the RS ratio scale. As I mentioned, industrials doing really, really nicely, and I expect industrials to move into the leading quadrant relatively soon. And then we've got technology and communication services inside weakening, but at relatively high levels. So communication services already seems to be starting to level off and ready to pick up again. Technology not quite yet. Let's take a look at a few of the individual charts right now. So here is materials, and I'm going to highlight the tail so that we know what we're talking about. Here you can see the improvement of materials. It's breaking above its resistance in the price chart, and you can see how relative strength has started to creep up. We put in a new low against that. It's exactly the same as we had those lows here. It's moving right up. RRG lines are being pulled higher. The RS ratio still needs work because it needs to move all the way over to the leading quadrant, but it seems to be starting, and especially the break in the price chart gives good faith, is good confirmation that it's likely to move higher. So keep an eye on the materials sector from a positive point of view. The second one here is communication services, and as we've seen it's moving into the weakening. Communication services is one of the sectors that has been leading the rally for a long time. It was one of the first that started to really pick up relative momentum. We have this massive inverted head and shoulders pattern which has now executed, and we reached the target around 69, 70 US dollars, and it's running into resistance. One would almost say as expected. I find that very hard word in technical analysis, but we would expect it, and it's happening right now. So a bit of a dip from this level, it would not be a surprise. Look at this chart, it's very steep. Looking at this chart, a bit of a decline here before moving higher would make total sense. And for the time being, that's exactly what you see in terms of relative strength. You see that since May, relative strength has not done much. Basically, when you move up like this and your relative strength line goes sideways, it means that the market that you're comparing it against, in this case SPY, has been rallying much faster. And that's what's causing the RRG lines to move a little lower. So the RS momentum line has now crossed below 100. That's why it's inside the weakening quadrant. But the RS ratio line is still well above 100. So if and when momentum starts to pick up again, it's very well possible that the RS ratio line will put in a low above 100, and that will cause the XLC tail to curl back up from weakening back into the leading quadrant, and then XLC will be one of the leading sectors again. Then we have energy. And energy, you can see here how energy went through a bit of a rough patch in terms of relative strength for 9 months roughly, and that downtrend's still there. That's why the RS ratio is well below 100, but momentum starts to be picking up, and that's why we see that move here. So when XLE really starts to pick up relative strength, and the fact that we're breaking out of this consolidation, call it triangle-like formation. I don't think it's a real triangle because we're missing this low here. So it's not really, it can't really be labeled as a triangle, but the trend line here is definitely there. The trend line here is definitely be there. And we're now running into a bit of resistance around, what's that? 87.5, 88. Is definitely encouraging. And if that holds up and can push higher, we will see more improvement in relative strength, and XLE can start to move higher on the RS ratio line. For the time being, the downtrend in relative strength is still there. It could be a very early call. Too early to my taste, but some people like to live dangerous. So here is XLF, that's financials, and you can see how that is also still at a relatively low level on the RS ratio scale. But the heading is nice and the improvement is definitely there. Look at the how the RRG velocity, so the distance between the observations, all of a sudden is starting to increase. That suggests that the power in the move is starting to increase. And that's what you see here. This is magnifying this move here, where you can see it's coming out of a low, starting to move higher. RS momentum already above 100. RS ratio now following suit. That's causing it to move higher in the improving quadrant. There is obviously still quite a bit of overhead resistance left that needs to be taken out before financials can go into a full-fledged uptrend. But the upside potential from current levels to the range here, that's 36 to 37, is still very much there. When that can be taken out, then the old highs here at 41.5, 42 are definitely going to get back into reach. And then we have industrials, as I said, probably the strongest sector at the moment, especially also when you take into account the fact that it moved into uncharted territory, broke its all-time highs, and it's holding up very well, I've got to say, above that breakout level. And for now, that's starting to pick up. That relative strength is starting to pick up very solidly as well, and that's causing the tail for XLI to move towards the leading quadrant. So XLI at the moment, definitely one of the strongest sectors. I wrote a blog article about it last week, focusing on the trucking sector, like trucks and trucking services seem to be doing really well inside that sector. And then technology, that's a bit, I think that's probably the riskiest sector at the moment. If you look at the tail, it's moving into weakening. Here also, you see the opposite of what we saw with financials, where the distances are increasing, but now they're increasing at a lower heading. So that puts technology in a bit of a dangerous spot. Still very strong reading on the RS ratio scale, but I really don't like the speed of the move and the fact that it's not leveling off. And when you look at the price chart, you can see that it broke to new all-time highs, but it's breaking back. So that former resistance, which was expected to act as support, did not fulfill that function, at least not to its fullest extent as we would expect. And it's breaking back below. That's usually not a very good sign. There is this little trend line that I've drawn in here. I penciled it in here, but as you know, I pay way more attention to the horizontal levels than to the angle trend lines. So I think that technology is in a bit of a risky area right now. And if I bring up a let me update this. Come on. Just a normal price chart with a price performance oscillator and the RSI, and put that on a weekly scale, then I think what I'm seeing here is a negative divergence that's executing, and that's sort of putting a little bit of overcast on the outlook for the technology sector. And you can see how the PPO has started to curl over and almost giving a negative signal. So technology, I think, is the sector to watch from a negative perspective, although the fact that it's still inside the weakening and relatively strong, I think that the price performance here could be facing a little bit more pressure. And the big question is where that pressure will end. Will it take it all the way back to 150 and then put in a new higher low? That would be good. It would help the S&P. But if we would get more downside price pressure on such a big sector, that could obviously be dangerous for the S&P as a whole. So where I said bonds are the risky factor from an asset allocation perspective, I think that the technology sector is the risky factor in sector rotation for the S&P 500 going forward. So please keep a close eye on that one. We really don't want to start seeing this taking lower highs and lower lows, i.e. reversing that nice uptrend that we see here. Staples. Staples still sideways, very close to breaking to new all-time highs, but the relative strengths, very clearly still lower, leveling off, but RS ratio at very low levels. It's a bit of a momentum hiccup, as you can see here on the chart. If you look at real estate, that's picking up quite nicely. It came out of that falling channel, so that's the good news, but the relative strength line is still very much in a downtrend. You can see how low the reading on the RS ratio scale is, so for the time being, that's also going to be labeled as a hiccup within a downtrend. I don't see any reason why real estate would all of a sudden reverse that downtrend in relative strength. It's possible, but I think that we will have plenty of time to observe that happening, if it's happening altogether. Here you got utilities. Utilities, again, inside the lagging quadrant. You can see why that relative strength line is pushing lower and lower. RS ratio is a very low level, so here also, for the time being, just a hiccup within the downtrend, looking for a little bit of a up move and then moving further down. When utilities will break below 63 or eventually 60, that'll put even more pressure on it. On the upside, there's plenty of overhead resistance, so I don't see utilities all of a sudden going into a massive rally to the upside. Now we got healthcare, pretty much the same, one of these defensive sectors, a momentum hiccup, a momentum rally. Look at the relative strength, which is moving quite strongly lower. It's just that this little hiccup here gets magnified by the RRG lines, moving higher. Momentum is crossing above 100, that's putting it into the improving quadrant. But as I said, it looks to be only temporary in nature, because relative strength itself is still pointing strongly downward. And from a price perspective, it's caught in a sideways range with some overhead resistance around 140, 138, 140. And then you can see this little upsloping line here and the previous lows on the downside. So here, there's not much going on in terms of potential breakout levels and ensuing rallies or declines. And then the last sector is consumer discretionary, which is nicely inside the leading quadrant. You can see how we turned around this downtrend here a couple of weeks ago. We're now challenging this overhead resistance level, which is around 172.5. The relative strength line actually is doing very nicely. You see how it's putting in new higher highs and higher lows. So here, this seems to be a temporary loss of momentum, and I would expect this relative strength trend to continue and eventually push XLY up to the 185 area. Maybe not immediately, and the only thing that we really want to see is for the raw relative strength line to hold up and not start a new series of lower highs and lower lows. Kind of wraps it up for the sectors. As I said, it looks as if we're going through a bit of a momentum shift, a momentum rotation that's taking a little bit of a toll on the S&P 500, most likely because of the weakness in the technology sector, which is, I think, is the biggest risk at the moment. And on the opposite side, we've got industrials and to a lesser extent materials, where at least opportunities to the upside seems to be arising. And that's it for this week. Thank you for watching. Show came out a little bit longer than 30 minutes, so I hope you don't mind and you stuck with me to the end. As you know, Sector Spotlight is available on demand on the StockCharts YouTube channel, usually recorded and uploaded on Mondays, but not today. As usual, feel free to share your thoughts and ideas to the comments below the video, or use any of the handles on the screen to get in touch. Looking forward to seeing you again next week at a new episode of Sector Spotlight. Same time, same place.